Welcome to the Wolvolution Guide to Lifetime Trusts. Lifetime trusts, also known as inter vivos trusts, are trusts which are set up during the settlor's lifetime, unlike testamentary trusts, which are created by the testator's will. A lifetime trust is more flexible than a testamentary trust because the settlor can use it to plan for a range of eventualities during his or her lifetime. Furthermore, lifetime trusts fall outside the scope of the Inheritance Provision for Family Independence Act 1975, which can give a disgruntled party the right to make a claim against your estate. Lifetime gifts into trusts can also be classed as potentially exempt transfers, which means that they can be transferred free from inheritance tax, provided the settlor survives for at least 7 years after the disposal and does not continue to benefit from the property after it has been placed into trust. Property that is placed into an asset protection trust can be protected straight away as the asset is removed from the estate immediately. We offer the following types of lifetime trusts. Let's take a look at each one in turn. Asset protection trusts are often marketed as a way of protecting your property against care home fees. Unlike a property protection trust, an asset protection trust can protect both property and capital, and does not require a severance of title, as the entire asset is transferred into the trust during the settlor's lifetime. As an added bonus, you will be able to continue to reside in the property and enjoy its benefits whilst it's in the trust. It is worth mentioning that property that has been placed into a lifetime trust will not qualify for equity release. If you plan to use your property in this way, you will have to consider alternative options. Many practitioners are reluctant to provide this trust because they are very easy to get wrong if the provider does not know what they are doing. Furthermore, a transfer of property into the trust within 6 months of a settlor going into care could be defeated by the local authority, provided that they can show that the main reason for the transfer was to deprive them of the asset. In order to avoid this, the settlor must be able to prove that the trust was set up for some other substantive reason. For example, to protect the property from a second marriage or to reduce probate costs. You might even want to place the property in trust so that your trustees can have control over the property should you lose capacity in the future. If, for example, you state that the trust is being set up to avoid probate costs, the amount saved must be more than the cost of the trust. You must also be able to demonstrate why you did not consider alternative options. For example, an LPA for property and finance could also be used to give your attorneys control of the property should you lose capacity. The Charging for Residential Accommodation Guide provides guidance for local authorities on how to interpret and apply the various legislation used to carry out financial assessments. This has become known as the CRAG Test. In order to pass the CRAG Test, you should be fit and healthy at the time of the disposal, without a foreseeable need of care. Even if you fail the CRAG Test, the local authority only has 6 months from the date that the asset was transferred to bring a claim. If you do not require residential care within the 6-month period, your property will not be caught by this legislation. As a last resort, the local authority may attempt to overturn property transfers under the Insolvency Act 1986. If they feel that they have grounds to claim that the transfer was designed to defraud them as future creditors. No time limit applies for this type of action, although the standard of proof is higher than that required under the Health and Social Services and Social Security Adjudication Act. If the local authority is successful, they have a number of remedies available to them, including ordering the trustees to pay the care fees or applying notional income, which means that your care fees will be calculated as though you still own to the property potentially depleting your savings and assets until there's nothing left. The local authority can also force the recipient of the property to pay the outstanding care fees or place a charge on the property to recover the money when the property is sold, although they do not have the power to force the sale. Professional legal advice should be sought in the event that the local authority attempt to bring any type of claim against you. It is essential that you explore all of your options before creating this type of trust and use a reputable provider. We work closely with our specialist partners who have a wealth of experience creating asset protection trusts and will take every step to ensure that your property is adequately protected. Any assets which you retain an interest in will be viewed as a gift with reservation of benefit and will be included in your estate for inheritance tax purposes. Furthermore, granting an individual the right to occupy or receive income from trust property will create a life interest, which is viewed by the HMRC as an interest in possession. This means that the trust property will be added to the life tenant's estate for inheritance tax purposes, unless the life interest is granted to a spouse. This renders an asset protection trust completely ineffective for inheritance tax mitigation. A pilot trust is a discretionary trust set up during the settlor's lifetime. The trust prevents excess capital from being added to a surviving spouse or partner's estate by placing it directly into trust. An asset must be placed in the trust upon creation. It is possible to transfer as little as £10 into the trust, which is created by deed. Unlike an asset protection trust, a pilot trust is a great tax-saving tool. Furthermore, the discretionary nature of the trust means that the trustees have the power to adapt to unforeseen circumstances and act in the best interests of the property and the potential beneficiaries, withholding and releasing trust assets as appropriate. The trust can also be set up so that the trustees have the power to lend capital to the beneficiaries using an IOU. This will create a liability against their estates, which will be paid back to the trust upon the beneficiary's death, reducing the value of the estate for IHT purposes. A spousal bypass trust is designed to receive payments which are paid out upon a settlor's death, which would normally go to a spouse, for example, a pension or death in service benefits. Many pensions can be set up so that the proceeds are paid directly into a trust. However, problems can arise when proceeds are paid directly into a standard trust because the property automatically becomes part of the beneficiary's estate. This could give rise to a new inheritance tax issue later down the line. The proceeds will pass outside of the estate directly into the trust, giving the beneficiaries immediate access at the trustee's discretion. As with a pilot trust, the trustees can access the trust property immediately without having to wait for a grant of representation. As a spousal bypass trust is discretionary in nature, the trust property will be shielded from claims against the potential beneficiaries' estates, as no one is guaranteed to benefit from the trust. The following assets can be placed into a spousal bypass trust. The provider should be contacted where a policy has already been written into trust to ensure that renomination is possible before attempting to set up a spousal bypass trust. The value of any non-exempt gifts made within 14 years of the trust being set up should be subtracted from the nil rate band allowance to calculate the value limit of the property that can be placed into the trust. Exempt transfers include gifts of surplus income and business property that benefits from 100% relief. For more information on lifetime trusts, feel free to contact us at info@willvolution.co.uk or via our website at www.willvolution.net.